But globally, Nilesh, SaaS companies have also come down. A clear example is Freshworks. Freshworks, I beg your pardon, thank you.
Yeah.
It had a great listing. SaaS, the first Indian SaaS company to go public, and then it's down, it's struggling, it is not reporting great numbers.
Yes.
So while SaaS is a great idea, but theoretically, globally, SaaS companies are not doing well. And I've seen globally what happens normally adopts here.
The challenge with those companies is that they still don't make money. Yeah. They still have losses. Some of them have accounting losses because of high ESOP provisioning, but otherwise they don't have clear demonstrable earnings to showcase. And public markets are always about earnings and cash flows. No matter what you grow, but earnings and cash flows matter the most. Fortunately, in India, we have some of the companies in this bucket which have relatively more consistent growth. They may not have the hyper growth, but they still have growth and also have strong earnings and cash flows. And I also believe that this is not just India's decade, it's India's decade. And therefore, any company which has deep tech capabilities and has a wide-ranging use cases in the Indian context, I think can be in for good times.
Any new acronyms?
Well,
you always give us one.
No, none for now. But I think so. So again, coming back to technology, I still think that there are several opportunities in the broader market. I think if you take your eyes off the top 3, 4, 5 names and look at maybe some of the other companies, I think there are interesting opportunities.
What is your basket of tech looking like then? MapMyIndia is one. I think you had LTT.
LTTS is something which we continue to own. NewGen is something that we have liked, and I think it's a very interesting company also. So I think for now, I think we have these 3, 4 such kind of companies which we believe have a very good runway of growth. But I think we keep scouting out for opportunities there.
Nilesh, we talk about banking, and the sector has just delivered parabolic earnings growth. Stocks did very well in 2022. They did reasonably well in 2023. But is banking more like a consensus trade? Everybody likes it, everybody owns it, and that's when the underperformance will start. And this year the bank which did nothing, frankly, if you think about it.
So again, I probably think, Nikunj, that even in banking we could go something similar to the way we've seen in IT.
Okay, so let's do that.
That the top 3, 4, like the top 3, 4 IT companies, I think similarly the top 3, 4 banking companies will probably grow in double digits.
Okay.
So obviously that growth rate is better versus the top IT companies, but I still think probably they'll grow at about maybe 15% plus minus 2-3%. I think versus that we will see a lot of smaller banks or specialized lenders. Or maybe some of the fintechs itself who can grow at a much, much higher pace. Okay. Who could potentially grow at twice the rate of any large bank. And I think therefore still there, I think one should look out for some of the emerging names out there. Some of them have IPO'd themselves recently, some of them have IPO'd over the last 2-3 years. But that's again a very, very interesting space.
But Nilesh, in banking versus IT, it's always said that size matters and the right to win, the CRASA, the brand recall, cost of liability is always with the large guys. You look at the cost of liability of SBI and I compare that with a Chotu PSU bank. Similarly, HDFC Bank, service, network, market domination versus a small bank. While the rate of change could be different, here we are talking about customer experience, ability to withstand the shock, bet on size and market share gains. They still are moving towards large cap banks.
No, that point very well taken. But what we have seen essentially is that one is, of course, apart from all of this, what you mentioned, I think the credit cost is, I think, very important. Your ability to, price your loans well, price your risk well. I mean, to know risk well, price it well, and monitor it well, I think is the defining feature of any banking business or any lending business. I think any bank who gets that right, irrespective of the size, will be a winner.
So cost of liability is important.
Credit cost, I think to me is the most important thing, followed by cost of liabilities. And what's happening, Nikunj, I think is, unlike the past, maybe 10, 20 years back, you probably had faith only in the top 2-3 names. Yeah. But I think thanks to an extremely good regulatory environment, the fact that we have such proactive regulators, I think they have been able to create a lot of trust and faith in the system. Look at what's happening to banks in the US versus the banks here in India. Okay, huge difference. And I think a lot of credit for that goes to our regulators,
Yeah.
who have been able to create that faith in our financial system and in our banking system.
What happened with some of the banks was an asset liability mismatch. Unheard of. That situation unheard of, at least in India.
So I think a lot of the smaller players in India have been able to either create a very good liability franchise or have been able to raise a lot of capital from private equity funds, and therefore today have enough cushion to grow at least for the next 2, 3, 4 years. So I don't know what will happen maybe 5 years later or 10 years later, but at least for the next 2, 3 years, a lot of the smaller and specialized players in the banking and lending and credit space will probably do much better than the very large and the very obvious names.
You've been a happy investor in IDFC Bank. I think you bought IDFC Limited and IDFC Bank both, and now the merger goes through. The stock has gone almost 3x in last 1.5 years. Are you, as of today, do you see that becoming one of your core, will it stay one of your core holdings for next 2, 3 years?
It looks like, Nikunj. I think they've done a fabulous job on execution. Look at the kind of challenges which they faced. As they say, that it's an existential crisis. And I think at least so far they have been able to convert that adversity into an opportunity, where they, in this period, they essentially wrote off all the legacy loans. They built a very solid liability franchise of maybe 45 to 50% CASA.
Low NPAs.
Managed credit costs very well, especially on the retail book. Obviously, of course, the naysayers will keep saying, let the book season, we will have to see what the credit cost is and all of that. But you have to keep in mind, they have been doing this for 15 years and not the last 5 years in their earlier avatar as Capital First. So I think on the whole, it looks fantastic. I think if they continue to do what they do currently, I think they have a great chance of being an outstanding bank. The big lever which they have is the cost to income ratio. If you look at any of the big banks, the cost to income ratio is at 40 to 45%. For IDFC First Bank, it's at 70 to 75%. That's because they've been investing in branches, people, talent, technology.
Legacy also was a challenge for
all
them,
of that. If over the next 5 to 10 years, if they can basically bring down that 70, 75% to 40, 45% and keep growing the loan book at maybe just about 20%, that can translate into some really nice compounding earnings growth for a long period of time. And so I think they have a fantastic opportunity ahead of them. They have great levers out there. Let's hope for the best.
It's been a new learning for me.